All right, well, good afternoon, everyone. Thank you for joining us for today's Keeping It Simple webinar. Today, we are going to be discussing whether Bitcoin makes sense within a diversified portfolio. Harley Bassman, managing partner and investing legend, will be joining Michael Green, who's chief strategist, and Burr the Saddle of Crypto Bulls. We're delighted to be joined to have our guest today, Mark Yusko, who's the founder and CEO, Chief Investment Officer of Morgan Creek Capital. This discussion is meant to be entertaining and should not be taken as investment advice. For more information on Simplify and our products, please visit simplify.us. For more information on Morgan Creek, please visit morgancreekcap.com. So with that said, I want to try and start off with a poll. Eric, can you push our first poll to read the audience to see what everyone's view is on crypto? So would you describe yourself as a crypto bull and a Bitcoin bull? Would you describe yourself as a crypto bull but think there's better options than Bitcoin? Would you consider yourself a Bitcoin or crypto skeptic, but you could be convinced? Or like Harley, I'll never buy this stuff ever? All right, so let's give that a moment to get the results. Eric, can you show us the results? All right. So we have a lot of bulls in the room. So gentlemen, why don't you take it over and discuss these results? And
I win. We can go home.
I know. Wow. So this is absolutely fantastic. Well, listen, I know that everyone that is joining is probably sick of hearing me in the crypto space and the debating. So I was really thrilled to bring Mark on. Mark has been a really long-term friend of mine. As I put out on Twitter earlier today, he was actually one of my very first investors, took me under his wing as a young whippersnapper. And to the extent that we have a disagreement here, or we differ in our views on crypto, I actually, first of all, would say that I don't think we actually disagree very much at all on the broader theme of crypto and the idea of digital securities or digitally native securities. I think that's one of the things that I really want to spend some time exploring. But we also are perfectly capable of disagreeing on this topic without either one of us calling each other unpatriotic or evil or anything else, right? So this is going to be far less fireworks and far more exploration of some of the topics that we've talked about in the past. One of the things that Mark and I have talked an awful lot about, though, over the past couple of years is the changing character of markets. And I kind of want to use that as the ability to set the stage for what I really think is going on here. And so I'm going to spend a few minutes going through a few slides that provide some background and context on some of the phenomenon that we've talked about, and some of which I've never shared publicly before. So this should be kind of fun. And then we can start to talk about like the role that Bitcoin or that crypto plays in investment portfolios. And so with that, Mark, I really appreciate you joining us. Harley, I appreciate you sitting there stoically and not yet storming the castle. And so let's launch. I'm going to share my screen here, except for the fact that the host has disabled participant screen sharing. I'm going to fix that. Eric, can you... back office, can we get the screen sharing up and going? Mike Green, technologist. Here we go. I am the host now.
Excellent.
Okay, so keeping it simple. Look, from a 30,000 foot point of view, what is really important to me, and everyone can see, I just want to make sure people can see the screen that says equity convexity, the 30,000 foot view. What we're really trying to do at Simplify is to introduce strategies that allow a different form of return stream. And what that means is, instead of the linear payout that you would have associated with an S&P 500, for example, or any other equity exposure, you have the ability to accentuate both the upside and the downside. We use various tools to do that, but the simplest way of thinking about it is that we're using options, right? And the reason for thinking about doing that is because you think that the character of the distribution is quite different than what the market presumes is the underlying distribution. That certainly is the way that I think about it. And so from my perspective, concerns about both market meltdowns and melt-ups are heightening as Fed policies and other dynamics are pushing investors up the risk curve. Stan Druckenmiller has recently highlighted this. And one of the biggest challenges, and Mark will certainly chime in on this, is that, traditional diversification via bonds is just running out. Like, you can't really actually look to an asset that has no yield and say this can be used for 40 or 50% of my portfolio to protect it. And so increasingly, you're forced to think about how can I modify the payout and that distribution of the equity class itself, or adopt alternative equity classes like crypto or Bitcoin as ways of changing that portfolio performance. What I personally think is driving the vast majority of this, I definitely agree that the Fed is a key player here, but what everyone has always heard me talk about are the dynamics of the growth of passive. And so when you look at the flow of what's going into markets today, we're somewhere around 45% market share, passive investments in US markets. It's less than that internationally, but growing very rapidly. We're actually seeing more rapid relative adoption in the rest of the world. As everyone kind of turns on to the John Bogle low cost point of view, we're seeing this incredible dynamic, though, where that share gain is actually resulting in money leaving active management and flowing into passive management. And we're now at a point, JP Morgan estimated at the end of 2018 that we were looking at 90% of all trading activity in markets no longer having a fundamental basis. And so this
but Mike, I want to push back on that a little bit.
Sure, please.
I just think you didn't make the chart, probably someone else did. The chart's just mislabeled, right?
Okay.
There's no such thing as passive. There is only slow active.
Yeah.
Right? Passive does not exist. Passive is simply capitalization weighting. It is a momentum strategy. The S&P turns over 85% over 30 years. That's just slow. And other momentum strategies that use cap weighting simply pile into, without thinking, the highest market cap stocks. And that is a self-perpetuating mechanism in a highly liquid, or not in a liquidity fed environment like we've been in the QE era. So this idea of active and passive, I get it, but I just think it's mislabeled. It's momentum for momentum's sake. Momentum always works in a Fed-driven liquidity bath.
And I would echo that. I actually don't have the slide in this deck, but one of the slides that I've shared with regulators when I've tried to impress this point goes back to the articulation of what passive is by Bill Sharp in his paper, the Arithmetic of Active Management. Passive is described as literally, you never trade, right? You cannot trade. Well, how do you get into a market if you never trade? How do you get out of a market if you never trade, right? So by definition, it's an absurd label. It's the one that everyone uses, but I agree with you. It's incredibly disingenuous.
Well, the only one that fits that bill is actually the best performing accounts in the history of Fidelity are truly passive. They're the deceased and abandoned accounts, and they outperform everybody by a mile. And the real problem with this is,
I didn't know that stat. That's absolutely
true story, true absolute fact. Because they're the only thing that people look. Human beings do two things really well: we buy what we wish we would have bought, and we sell what we're about to need. And we are spectacular at it. We've all seen the JP Morgan data. If you bought the S&P 20 years ago and sat, did nothing, you made 7.5%. If you bought and held a bond index fund over the last 20 years and did nothing, you made 5.5%. The average individual made 1.9%.
Yeah. Because
they buy the top, they sell the bottom, and they are spectacular. Last point on this that I think is so kind of disturbing is again this idea of passive. Passive is dumb. And I don't mean unintelligent. I mean, it's rule-based. So let's just use a simple example. Home builders, right? Home building is a manufacturing business. A home builder should trade roughly 6-7 times earnings because it's a cyclical, volatile business. So home building new stock comes out and it's a tech play. It's Zillow-esque and it gets a 40 PE. No one should ever buy a home builder with a 40 PE, but the index must buy it because it's dumb.
Well, it's actually worse than that, right? Because as it transitions from 6 or 7 PE to 40 PE, the odds are that it's outperformed the index, which means that the dumb passive index is buying even more of it, right? We see this explicitly with meme stocks that have exploded, and now the largest stock in the Russell 2000 value is GameStop. I mean, this is completely insane.
Wait, a year ago, what was that? That was the largest stock in the DAX index. Wire something,
Yeah.
wire fraud. Yes.
Exactly.
And then it went to 0.
Yep.
It became the largest name in the index, the brilliant passive strategy, and then went to 0.
I completely agree with you. We actually just saw this in, it didn't take German precision engineering to accomplish this. We just got a going concern announcement on Lordstown Motors, right? Which, if you look at the flows, has seen active managers selling and Vanguard and BlackRock buying. I think the technical term is the crap out of it, right? And you just sit there and you're like, this is the way it works. And so the problem is, exactly as we're discussing, this has real world implications. And so some people may have seen me share this chart in the past, but this is actually looking at, and we're going to talk some of the dynamics about how a market that is transitioning from active to passive begins to behave. And one of the things that happens is if you look at measures of correlation or co-movement, and you make a very important adjustment, which is you hold volatility constant, right? Because one of the challenges in thinking about correlation or co-movement is you have to adjust for the levels of observed volatility. If you don't do that, then you can get all sorts of messy information. But when you do that, you get this chart, right? And it just tells you what's going on.
Do me a favor. Hit the escape button and go out of full screen, because one of the guests wants to see our lovely faces on the sidebar.
Got it. Okay, here, I'm going to switch screens then. Give me 1 second. Is that better?
There you go. Yeah.
Okay. So when you look at what happened in 2020 was this unbelievable experience in correlation, where the measure I'm using here is co-movement, which tells you the rolling 66-day moving average. So basically quarterly average for the number of stocks in the S&P that are moving in the same direction on any given day. All right. And throughout 2020, we saw in excess of 370 of the stocks in the S&P move in the same direction on any given day. Like, that's insane. There's no diversification in that. That's complete. You've completely lost the plot in terms of why you're buying into an index. But this is the world that we inhabit today. Yep. And the regulatory framework has changed that. Now, alongside that increase in correlation is, of course, the other side of it, which is the changing skew in the distribution of returns. So this is looking back to 2000 and highlighting the change in the character or the skew of the distribution of returns, skew measuring basically what are the fat tails. And what you can see is that equity indices have gotten more and more negative skew. In other words, the propensity to have big crashes at high rapidity is rising, while volatility indices are doing the exact opposite. The propensity to spike is rising, right? So a significant change in distribution is occurring. And if you actually look at that in kind of the framework of how you should expect behavior going forward, or what is actually going on, I've used the analogy to this where a fair game, a fair roulette wheel, or a fair market distribution is one where the assumption is that the forward price that's embedded into an option pricing is the same or is the most frequent observation, right? And so you can actually see in 2000, and my models, this is what my models would have predicted in 2000, you were kind of right on fair, right? Now the actual observed, because 2000 was a terrible year, was that you were to the left of that, but the expectation was that it was roughly fair, right? By 2020, you've seen this distribution shift dramatically. 2021, you've seen this distribution shift dramatically. Now, ironically, you haven't seen any of the left tail outcomes. We've been lucky in that framework, right? But the expectancy is rising. In other words, we're playing a game like going to a roulette wheel, and instead of black coming up 50-50, black is now coming up 70% of the time. But when red comes up, they kill you, right? So it's like it's a brutal game that we're playing, where you have to stay invested and you have to recognize that things are getting worse and worse. I actually highlight, this is appearing kind of off the screen. If you look at where March 2020 was, it was 7.5 standard deviation event, right? Now that it doesn't happen, right? That's one of these, once in a million years sort of thing that seems to happen every 5 years. 2008 was, for frame of reference, only about -4 in terms of standard deviations.
Yeah.
But so we've radically changed the distribution here. And this for me is part of what I'm trying to convey to people about the markets actually are different this time. And it means you need to have different strategies. It means that you have to approach things in a different way. And that's kind of where we start to go into Bitcoin and the alternative assets.
Mike, I think 1 second over here,
Sure.
not to distract from Bitcoin and all that trace, but I mean, what was the reasonable, logical plan B, seeing as up until now, I'll use the word index as opposed to passive from Mark, we don't get the dumb people there. Index has beaten active and beaten hedge funds, beaten everything else for the last at least 10 years. Like, what were people supposed to do?
Buy Bitcoin. No, I'm joking. The simple
By the
answer
way,
is,
index is still beating active.
I know. So the challenge is that there was nothing that you could do, but this is actually this goes back to Mark's point that passive is not passive. Part of the reason that we're seeing this change is because people are pushing into passive, right? Another way to think about this, we've all been to the fair.
Index to passive.
What's that?
Use the word index as opposed to passive.
Sure, let's use index. That's fine.
That way Mark's happy.
As people transition to indexing, it becomes like the carnival game that you play where you shoot water at a horse, the target and the horse is racing based on how much water pressure you have. So your accuracy drives your horse faster than other people. Well, the way to win that game is for you and your buddy to both shoot at the same target, right? And to create the horse moving faster because you're putting double the water pressure on it, right? Well, that's what's happening in markets. And we misinterpret that as the indices outperforming, right? Where everybody's basically getting into student body right type formation. And we're like, wow, this is really interesting. The ship seems to be tilting this way. There must be something interesting over there. Let's all run over to see what it is. And the risk is these tail events where all of a sudden it flips in the opposite direction or the whole thing goes all the way over.
Well, but Harley asked the important question, right? Is what do you do? And here's the interesting thing. To his point, right? Over 10 years, active has lost to index.
Yep.
True. Over 40 years, not true. They have the same return as you would expect them to have because they're both the market. Now, what's interesting about that is over the past 10 years, the only reason that equities appear to be higher is because of money illusion, right? If you denominate the S&P in a depreciating shitcoin, the dollar, then it looks like stock price go up. Not the case. If you denominate in the Fed balance sheet since 2009, stocks are dead flat. If you denominate in gold, which is hard money, they're dead flat since 1996. If you denominate in Bitcoin, it's not even close. So it's this illusion of things going up. So the way you won in the past decade was not to own stocks or bonds or commodities or anything else in the traditional markets. You wanted to own Bitcoin, you would have outperformed by a huge margin, not even close. Even better than that, art, fine wine, collectible cars, anything that was scarce, because all we've done in the last 10 years is destroy the value of fiat currency, which is part of the reason we're even having this discussion today.
Well, I think that's actually a really interesting segue, because the first place that I always start with the transition to Bitcoin is to go back to gold, exactly as you alluded to, Mark, and to basically say, why do we think about gold as money? And I'm gonna, I apologize because I'm gonna have to do this again in terms of sharing my, actually that should be fine. So give me 1 second here. So, when we talk about gold as money or gold as hard money, it's one of these interesting things, and I have shared this previously, so I apologize if people are bored with this. And candidly, this was actually introduced to me back in 2011. And the question is, why do we think of gold as money, right? Well, what gold really was coinage. It was useful as coinage. And when you start thinking about why we cared about coinage, it was because it actually allowed the first governments, the king of Lydia, to introduce the idea of coinage that he was able to profit himself from in the form of seigniorage. He introduced coinage in what was referred to, a metal referred to as electrum, that naturally occurs as a 30% gold, 70%, or 30% silver, 70% gold mix. He re-smelted it at a 50-50 and eventually a 70-30 reversal mix to profit in the process, but use that to pay for the services that he wanted, right? And the question is, why would he do that? Why would he use gold? Well, the answer is because there are certain criteria that you needed. I should have gone backwards on that. The first is that you need to be able to avoid counterfeiting. That requires the ability to have some measure of purity, right? And that naturally gravitates you to the periodic table, right? You move to the elements. And then you start saying, what else is necessary about coinage? Well, it's really hard to have coinage that isn't a solid at room temperature, right? So
those
that
gases are tough to hold on to.
Those gases are really tough to stick in your purse and pocket, particularly if it's an old style leather purse, right? It's also kind of a bad idea to keep radioactive stuff on your person, right?
Marie would say, yeah.
That's right. Marie Curie benefited from access to it, but ultimately expired because of her poor choice of coinage. The next thing you need to consider is non-corrosive and non-toxic. Now, Vladimir Putin disagrees on this one, but with that notable exception, that starts squaring off another portion of it, right? And then this is the one that I think is actually kind of interesting, which is that it needs to be malleable at achievable temperatures, right? So if I go back 3,000 years in history, I can't get an electric arc furnace. I can't get an aluminum refractory that has the capabilities that we have today. And so I literally need to then say, what can melt at a temperature I can achieve in a basic furnace? And I'm left with 5 metals: nickel, copper, zinc, silver, and gold, all of which form the base metals in every form of metallic currency we've ever had in any population that has access to them, right? And then the next thing you do is you say, well, but if I want something for large denomination transactions, I want something that's rare, but not unobtainable, and I'm literally left with silver and gold, right? So what you have is an anthropic principle at work, right? It's like saying, why does the earth exist? Well, it exists because we're here to observe that it exists. Right? We think of gold and silver as money, but that's because they happen to be elements 47 and 79 on the periodic table that fit these particular criteria. And importantly, electrum, again, is a naturally occurring alloy of the two that you can dilute the less common gold with additional silver and create coinage from which a king can profit, right? So we've always had this story. We've always had this dynamic. Now, to Mark's point, why does that actually have value? Why does that create a quote unquote orthogonal return stream? Well, because if you're paying for something and ultimately there's an element of scarcity in the definition of money, the only solution set is for money to depreciate against that. And that kind of brings you into the Bitcoin phenomenon, which is it the modern gold, right? Is it the better way to think about it, a truly digitally native currency or a digitally native commodity that replaces gold, right? Now, I happen to be skeptical, but I'm really interested in Mark's perspective on this.
No, look, and this is where the fun part comes, because this literally is the aha moment. So, my backstory, many have heard it on other podcasts and stuff, is, a good friend of mine, Dan Moorhead, called me in 2013 and said, hey, come to San Francisco. I'm gonna shut down my hedge fund and tell you what I'm gonna do with the rest of my life. And he said, I'm gonna spend the rest of my life focused on Bitcoin and blockchain infrastructure. And I joke, although it's not really a joke, I made the first of my many bad decisions. I was not running drugs on Silk Road. I was not a cryptography student, didn't understand this Bitcoin thing. But as soon as he said picks and shovels, I went immediately to this gold analogy, which I'll talk about. And so I'm in. Now that fund, it's up 13x or something. I mean, no one's complaining. It's great. But I should have put the money in the Bitcoin fund because it's up 600x. Best performing hedge fund in the history of hedge funds.
Yep.
Now, why is gold so important? Well, gold is money. Everything else is credit. Gold is money. Everything else is credit. Gold exists without an associated liability. That is the definition of money. All other money, currency, not real money, is backed by debt. So if you have debt, your currency. If you have no liability, you are money. So gold's been money for 5,000 years. All the points that Mike made about its elemental purity, but most importantly, it became used through custom and precedent. That's it, right? For 5,000 years, 1 ounce buys a fine suit, a suit of armor, a zoot suit in the 20s, Savile Row today, buy a suit, 1 ounce fine person suit, okay? That has been a perfect store of value. 775 paper currencies. Now, why do paper currencies exist? Paper currencies exist because in the old days, I would have chickens, Mike would have cows. We would bring the cows and chickens to market and we would trade. But that's a pain in the ass and the poop and all that stuff. So we minted tokens. His would have cows, mine would have chickens. We'd bring the tokens, we'd change the tokens. Well, then it'd have a big old sack of tokens, and there's our pain in the ass, and people would rob us on the way. So we would deposit those Saxo tokens at the bank, and the Medicis were happy enough to start that for us. And they would issue paper currency, starting with the Chinese in 1300, called flying money, because if you didn't put a rock on it, it would fly away in the wind. But those paper notes were easy to transport, and we could physically exchange them for goods and services, again, by custom. There have been 775 paper currencies in the history of mankind. 3/4 of them no longer exist. They're gone. Why? Because the empire that issued them became profligate spenders, incurred a bunch of debt, collapsed, and the currency disappears. The oldest currency today is the pound sterling. When it was created 380 odd years ago, 1 pound note got you 1 pound of sterling silver. Today, it's 174 pounds of sterling silver to get a pound note. That is, seigniorage. That is theft. That is inflation, which is a fancy way of saying devaluation of the currency. Same thing with the dollar, right? We stole the word dollar from Holland, from the Rothschilds, who started the first central bank in 1600s. And we created the dollar in 1779 or whatever. And from 1779 to 1913, a dollar was worth a dollar. Had 2 little wiggles around wars, but it was basically worth $1. There was no inflation. And in 1907, actually 1908, JP Morgan and John D. Rockefeller cooked up an idea to create the Federal Reserve, the creature from Jekyll Island. They actually created it at Jekyll Island. You can't make that shit up. And why did they do that? So that the banks could steal our wealth through this silly notion of inflation. And that's why we have the greatest wealth and income inequality in the history of mankind. And so it's not a surprise that gold was outlawed in 1933. It's not a surprise that it was illegal to own gold as a US citizen until 1974. Interestingly, bet people didn't know that Satoshi Nakamoto's birthday is 4573. Why is it 4573? Because 45, April 5th, was the day that the US banned ownership of gold in the United States. 1973 was the year it was returned. Interesting. Not surprising or shocking that Satoshi Nakamoto, whoever he, she, they are, came to be, Bitcoin came to be in 2009 at the trough of the financial crisis. Not surprising that the first entry in the Genesis block is a snapshot of the London Times article on the chancellor bailing out the banks for the second time. So all empires fall. British Empire fell. Remember, the sun never set on the British Empire from 1860 to 1913 when they invaded Mesopotamia. The sun never set on the British Empire. Today, it's a nice place to visit on vacation. And American empire is in the process of falling through this profligate spending and the devaluation of the currency. There is no way out other than devaluation of the currency, which is why Bitcoin exists and why everyone must have an allocation.
Mark,
That's a lot.
Before we start talking about value, of which there's very little in Bitcoin, but ignoring that small detail, let's just take your idea of nationalities. What creates a country? It could be their race, it could be their religion, it could be their language, right? All those things. I would say what creates a country is probably their currency, and therefore, to the extent that we go and create
currency is a byproduct of power.
Whatever
created by governments. Currency is created by the power.
That Bitcoin is an act of war against a sovereign nation, and why wouldn't we logically see a repeat of that 1913 or 33 act happen again? It's unclear to me how countries are going to allow Bitcoin to exist and rob them of their power at the end of the day.
No, they won't. And Bitcoin has become digital gold. Gold exists for, again, 5,000 years as a perfect store of value, but it lacks a couple things, okay? It's heavy, and it's not very portable, right? All the gold in the world fits in 2 Olympic-sized swimming pools. All the Bitcoin in the world fits right here. Now, I don't have all of it in the world. In fact, I don't keep any on my phone, so don't SIM swap me. I've been SIM swapped twice. They didn't get anything. I'm not dumb enough to leave it on my phone. So, but the problem is gold is really hard to store. It's expensive to store. And my other thing is it's not very divisible, right? There's a scene, one of my favorite movies is Knight's Tale. There's a scene where he wins the tournament. He gets this gold calf, and his, squire's gotten in trouble, and he literally bangs the calf and breaks off the leg and says, go do what you do with this. That's a really inexact way to divide. I can divide a Bitcoin into 100 million Satoshis. That's why my Twitter handle is hashtag 2.1 quadrillion Satoshis, 21 million Bitcoin, 100 million Satoshis each. So the reality is that it is far more divisible, it's far more practical, and it has all of the elements of gold and the elements of the digital age. And we went from the analog age. In the old days, if you and I, Harley, wanted to exchange a stock, you would bring a paper stock certificate, I would bring a paper piece of money, and we would meet under the buttonwood tree in New York, right? And we would exchange that analog thing. But the problem was, if you ever seen the movie Gangs of New York, we'd get robbed on the way by the Irish or the Italians, and they'd steal our stuff. So they moved it inside. But even that didn't work because paper could get wet. It could get mutilated. Bad things could happen. So what they did is they created this thing called the DTCC. And now all the physical pieces of paper, the analog stuff, sits in Dallas, Texas, in file drawers, literally paper stock certificates, bonds, and we trade QSIPs electronically. All we're doing is moving to the digital age. And the digital age, what Satoshi Nakamoto, again, whoever he, she, they are, did is they created the ability to solve the double spend. What's the double spend? In the analog world, if I had a paper dollar and I gave it to you, the only thing you had to ascertain was, is it real or is it counterfeit, right? Because it was you took the physical piece of paper from me, the analog exchange. In the electronic world, where today only 8% of currency is physical, 92% of it is electronic, ones and zeros, which, by the way, I have this recurring nightmare. Does anyone else have this? I go to the ATM and I punch to get some money out and it says zero. How would I prove it's not zero? I don't have statements anymore. It's their word against mine. So we have a lot of trust in those banks. And by the way, the money ain't mine. It's the bank's. If you put your money in a bank, it's no longer your money.
I'm not going to break up the party here. I will stipulate everything you've said and are about to say the next 10 minutes is true. So let's cut that off. My point is, why will governments of the world allow their power to be usurped? And maybe in the US, we're a little slow.
No, but Harley, you're missing it.
Russia
They don't have to.
They'll go and
Gold,
these people and shoot them in the head. I mean,
no, gold has existed very peacefully.
I understand that, but gold exists. We allow it to exist and we track it. We're not going to allow ransomware to go happen. You think you're going to have ransomware in Russia or China? That ain't going to happen, man. The U.S. government.
Do you think more ransom has been paid in dollars or Bitcoin?
To quote the Supreme Court, the Constitution is not a suicide pact. Okay, at some point they're going to go and put their foot down on this. I'm not sure when it happens,
no.
But it will.
Does more terrorist activity occur with dollars, paper dollars, or Bitcoin?
This
Well,
sounds like
it's
guns
just-
don't kill people,
let's-
people kill people. No, it's the same. I mean, there's levels
If
of
you
bad
had a
guys over here.
choice, if you had a choice between doing something bad with a sack of money or fingers on a keyboard, which one are you choosing?
I think I want to do things where I'm not going to jail and where I anticipate the government's going to go control it. As a matter of fact, how would you feel if they went and demanded an FBAR filing for every Bitcoin holder that was out there? Because it really is, I agree, it is a currency. It is a currency, so we agree upon that. I guess where we disagree is just when it's going to zero. I'm sooner than you are. But I mean, I just don't see how.
It'll never go to zero. I mean, to say it's going to zero is just a silly statement. So here's the thing. There's never been a technological innovation in history that improved mankind that went away. Right?
We're not arguing
That's the
about
way-
blockchain.
that's the way society works.
We're not
That's the way
arguing
society
blockchain.
works.
We're arguing
Technology
Bitcoin as a
evolves. Would you say that the mainframe computer should come back? Should we not use personal computers? Should we not use handheld cellular, supercomputers? Should we go back to using mainframes? Hell, why don't we go back to using abaci, however you say it?
So Mark, let's time out for a second here, because we are turning this into a debate rather than a discussion, right?
Okay.
So I think the thing that you guys are both saying, and again, this is kind of where I come out, is there are unquestionably innovations that are occurring here, right? The idea of the ability to have digitally native currency or digitally native securities is something that you're 100% correct, but we haven't gotten rid of mainframe computers. We haven't gotten rid of abacuses, right? We treat them as decoration now, but they still exist, and there's still abacus manufacturers out there, just like there are buggy whips and saddles and everything else.
Yeah, but we don't use them.
Some fraction of the public does, right? People use saddles, people use buggy whips, right?
You are correct. The Amish still ride in horse-drawn carriages. You are
Right.
correct.
So there are elements of that, and we're basically arguing the question of adoption, right? I agree with you that the technology is not going to end up going away. It is an interesting question, though, about how to diversify the specific risk that effectively Harley is articulating, which is the first mover disadvantage in the digital currency space, right?
Perfect. It's not a disadvantage. We live in a different world. We live in an open source world. So in the old days of technology, right? Let's go back to MySpace and Facebook. So I was just with the Winklevi down in Florida. Think about this. These guys were at the forefront of, social media, arguably invented one of the most powerful companies in the world, along with Zuck. And then for their second act, they've now gotten involved in Bitcoin ahead of everybody. And for their third act, now they're getting involved in NFTs. So to be right once is amazing. To be right twice, unbelievable. To be right 3 times, absolutely incredible. But the point there is, I lost my point. I got so excited, I lost my train of thought.
No, so what you were referring to is the dynamic of it not being a first mover disadvantage.
Oh, not first mover. So MySpace had good technology, and Facebook came along with better technology, and so MySpace got outcompeted. Well, there's this little company down the road from where I live in North Carolina called Red Hat, and they started something called open source. And now technology exists open. So I have Bitcoin. I have this wonderful innovation that solved the double spend problem, right? In the old days, I had a music file. I want to share it with you. I made a copy, sent you the copy. No one cared except the music industry. So what did they do? They did what you do with a hierarchical corporation. They arrested the CEO and blew up the server. So Napster no longer exists. So now we have streaming services, digital music, ubiquitous to everybody, but we all have to pay for it. So we went from analog to music albums and CDs to MP3s, electronic, to now digital. Same thing's happening with money. But the problem is electronic, if I have a copy of $1 and I send it to you, and that's fraud, right? So what we need is a bank to say, well, no, Mark has $1 in his account that I watch, and Mike has an account. We charge them for the accounts. We charge Mark to send Mike $1. With Bitcoin, we use technology. We use the most powerful supercomputer in the history of mankind, the Bitcoin blockchain, 1,500 times more powerful than the CERN supercomputer. It is the most secure network in the history of mankind and the most valuable network in the history of mankind. And it says three things. It says, one, Mark has a Bitcoin. Two, he actually sent it to Mike. And three, now we append that block in the transaction to the chain. It is now permanent, cannot be reversed. So by using that strategy, if someone comes along with something better, right, I can copy paste whatever that technological innovation is to Bitcoin and make it win. And Paul Romer, who I'm sure you know, right, won the Nobel Prize 2 years ago for his theory on increasing returns. And it's not the best technology that wins. It's the technology that gets critical mass first and achieves the Metcalfe's growth. And that's what Bitcoin has done. So it is not a winner take all. There will be lots of innovation. There will be DeFi. There will be other chains. But Bitcoin as digital gold and as the base layer for the internet of value. Look, money over internet protocol is the most important technological advance this century, bar none. And it is not going back in the drawer. There is no chance we are not all going to exchange money and value over internet protocol using the Bitcoin blockchain. Not even a question.
I think this is ultimately where we disagree, and I'm not sure there's an easy way to resolve it other than to fast forward.
Well, we should have a dialogue in search of truth.
Well, but this is actually part of the point, right? We actually can't make a decision about what's going to happen in the future, right? So your assertion is that Bitcoin has achieved the first mover advantage. Its network is now large enough and its value contribution is enough that it can't be supplanted, right? It can't be replaced. Right. I disagree with that because I look at the end use. So I look at the $1 trillion market cap of Bitcoin, give or take, $1.5 trillion, right? Yeah. And I look at the dynamics of how small that is relative to the actual aggregate value of financial assets that are largely denominated in fiat currencies. And to Harley's point, fiercely defended by a system of laws and legal systems that encourages or creates the dynamics of seigniorage, which is necessary in a lot of ways to pull together societally robust solutions, right? We can't rely on a group of plutocrats to necessarily fund the social activities that we all rely on, right? So I think we just disagree in terms of how penetrated it is.
No, we actually agree vehemently here. This is what's really cool. See, we're actually not disagreeing.
Okay.
So I don't disagree with you at all that Bitcoin is a small part of this much larger thing. So let's think of a stack, right? Yep. Today, okay, gold or Bitcoin went from zero, right? From a science experiment to $1 trillion of value. How did it do that? Through adoption. Okay, What is that on the way to? Today, at $1 trillion, it is roughly equivalent to the other 4 major networks that exist in the world, right? The most valuable networks in the world are Amazon, Apple, Facebook, and Microsoft. They're not companies the way we think of companies. They are networks. They're made more valuable by having more participants in the network. Take Amazon. What does Amazon do? They don't do anything. They match buyers and sellers and they take a cut. They are a network and they grow exponentially according to Metcalfe's law. So all of these cluster around $1 to $1.5 trillion. The next level is the monetary value of gold, around 4 trillion. Okay, that's all of gold's about 8 trillion. The monetary use, bars and coins and what we would actually think of as money, as opposed to jewelry or ornament, is about 4 trillion. So Bitcoin will migrate to that, and it will, I believe, be a better form of digital gold. Okay, then the next thing is, well, what about M2? What if it starts to chip away at being a reserve asset? Not the reserve asset, but a reserve asset. So there's $86 trillion of global M2. Let's say that central banks around the world, instead of just owning dollars, euro, yen, and now renminbi, because they will own renminbi, that they start to add Bitcoin as a asset. El Salvador is in the process of doing that right now, and others will follow. So now we start migrating up toward that 86 trillion. I don't actually believe we're going to blow up governments. I don't believe we're going to blow up all of banking. What we're going to do is disintermediate the primary peer-to-peer exchange of value that banks have refereed for the last 700 years and been rent seekers. And I think we recapture that $7 trillion of wastage. Governments will still issue fiat currencies. Governments will still devalue their currency. There is no way out for the euro, the yen, the dollar than to devalue. They can't pay the debt back. They can't restructure it. They can't do anything other than devalue it. So we actually do agree that this is a small thing today that's on its way to becoming a bigger and bigger component. Where I get really excited, and what we don't have time to talk about today, and we'll do this again, is think about Bitcoin as you would TCP/IP. 30 years ago, there were 80 protocols. Today we have 5, right, in the internet. The internet changed everything. The internet changed everything in our world, changed media, changed commerce, changed everything. And it was 80 competing protocols that went to 5. We have TCP/IP at the base layer. We have HTTP, SMTP, FTP, and www. Those 5 protocols drive everything. If we now go to Web 3, all right, which is Web 1, think about an XY axis and think about a parabolic curve. The left-hand side, Web 1.0, the area under that curve, pretty big, right? That was a lot of wealth. That was Microsoft and Cisco and Intel, pretty good. Web 2.0 starts to make the knee of the curve. That's Web 2.0. That's Netflix, Amazon, Alibaba, more wealth. Now we're going parallel to the y-axis. That's Web 3. That's the age of the trust net or the internet of value. So that is what's going to be powered by blockchain as an operating system, just like iOS and Android, just like DOS and Windows. And that will all be driven by Bitcoin as the base layer. Ethereum, I'll argue, is the www dot, it's the toolkit. Then we've got Filecoin, like FTP. And now we got 2 others. Maybe it's Polkadot, maybe it's Cosmos, maybe it's Solana. I don't really know. I'm not a techie. But we're going to have the same technology stack. And all we're going to do is migrate from the traditional internet to the trust net.
Mark, are you describing Bitcoin as a store of value for when we traded cows and pigs, or are you describing it as a speculative investment? Because it is a store of value. It's clearly not a store of value.
It has a role as a store of value. Okay.
It can't be a store of value. I mean, the yen has a vol of 5, the euro has a vol of 6, the ruble has a vol of 10, Venezuela has a vol of 30, and Tesla has a vol of 50, and Bitcoin has a vol of 91. Like, that's not store of value, man. I have no idea how many loaves of bread I could buy next week. I'm not saying that's bad. You could just say it's an investment and not a store of value, and then we're happy.
Yeah,
gold fell. Wait, will you agree with me that gold is a store of value?
Sure, has a very low vol. I know what it's.
Is gold a store of value?
Sure.
Okay. Gold fell from $1,900 to $1,000 from 2011.
All you're telling me is that Bitcoin went up in price. Okay, it went up in price.
Did gold cease being a store of value when it lost half its value?
Which it did over 100 years, unlike Bitcoin.
5 years, 2011 to 2015, it fell 50%. Did it lose its store of value principle?
I'm not sure. This is psychological here.
Is gold still a store of value?
What was the vol of gold over those 5 years?
Guys, let's time out here, right? The thing to me that's actually really interesting is what we're ultimately discussing here is a difference of view in terms of what a dominant network is, right? So, Mark, for your perspective, Bitcoin is the most valuable network. I would point to the United States as a network and say, no, it's significantly more valuable than Bitcoin. It is a framework, et cetera, right? And so I think what both Harley and I are skeptical about is the idea that those larger networks, those much more successful and much more valuable networks, are going to cede the control of critical operating systems and functions that you ultimately are highlighting. I personally, by the way, I just want to highlight this. I personally think that part of what's happening is that gold is losing its store of value. That ironically, part of what's occurring is the gold bugs that for years and years and years insisted that gold is money are now suddenly saying, well, maybe it's Bitcoin that's money, right? And ironically, I think that makes them both weaker. I think it actually creates the conditions under which the fiat system is ultimately going to be stronger because it's managed to divide its enemies. It's going to be really interesting. I don't think we know the answer to it, but let me ask the question differently. Mark, you have an exceptionally high degree of confidence that we've made that transition. So for you, it's very easy to think about it from the standpoint of, I want to index myself and allocate myself to this technology.
Yeah.
When the average person looks at this, though, I think it's far harder for them to distinguish between, do I want to go all in on this technology or not? They haven't had that.
Oh, no one said all in. Never, right?
Okay.
And that's the beautiful thing. This is the most asymmetric asset I've ever seen in my career, right? And look, I got white hair. I've been around a long time. I've seen every innovation. I remember a time when I first got into business.
Mark, you had white hair at 40. So,
yeah,
you know.
But here's the thing, Mike, you know this, right? When I started in this business,
yep,
it was deemed fiduciarily improper to own equity. Right? Cover story of Time magazine, 1979, the death of equities. No, quote, no self-respecting fiduciary should ever own equities again. Okay?
Which remove an element of the hyperbole, right? And we all know the magazine cover dynamic, et cetera, right?
No, but my point is, there was a time when equities were deemed fiduciarily improper, when international equities were deemed fiduciarily improper. ERISA came along and changed that. Then hedge funds were deemed, like when I suggested hedge funds to Notre Dame back in the 90s, they told me that's where all the bad guys were. And then we said, hey, we need to do junk bonds. They're like, oh no, Michael Milken, he's a bad guy. We can't do that. I'm like, wait, you realize that those are senior to 65% of the portfolio in equity, just the way math works in accounting. And then it was private equity, and then it was venture capital. And what we've seen is every innovation has a very high correlation to traditional assets. What Bitcoin has, and why everyone has to have it, and why 5 years from now, it will be deemed fiduciarily improper to have zero allocation to digital assets. If you are a fiduciary and you don't have exposure, you will be derelict in your duty. Why? Because 1% allocation of Bitcoin over the last 5 years. I won't even use the 10 years. I'll just say the last 5 years when it was really liquid, and you could have done this with all of the endowments in the country. Could have taken $6 billion, 1%, put it in, 0.5% from stocks, 0.5% from bonds. Instead of compounding at 7.2, you would have made 9.2. And here's the cool part. Had it gone to zero, which hardly believes it could, which I'll say not going to happen, but even if it had, you would have made 7. That's a 10-to-1 upside downside, the asymmetry of this. And if we make an assault on global M2, and if we become an $80 trillion asset instead of a $1 trillion asset, you're talking about an 80x. You have to have some 1 to 3% exposure to Bitcoin, then another 1 to 3% in Ethereum and DeFi and other things, and then another 5 to 10% in the picks and shovels. I spend most of my day investing in the infrastructure around the ecosystem. I've made way more money investing in BlockFi and Coinbase and the companies that propagate this ecosystem than I have actually in Bitcoin, because I was not in Bitcoin in 2009. I was just.
So I think that's actually, so we're going to run out of time, but I actually appreciate you bringing that up, because effectively what we're arguing for is the level of allocation. And that's, I happen to know some of your limited partners who have the very high class problem of having made a 1% allocation and are now struggling with a 4% allocation, where the contribution of that 4% in terms of volatility of their overall portfolio is too high, right? They can't manage against that. And that's part of
actively rebalance. And wait, I know someone who might do that.
Oh my gosh, thank you, Mark. Now we're on the same page. So when you think about that, like part of the reason why I've approached this from a strategy standpoint, right, is recognizing that advice of, hey, how about you put 1%, is extraordinarily hard for people to do, right? Whether you're a registered investment advisor and you're dealing with clients and you suddenly have a situation where 1% of your portfolio is now taking up 75 to 80% of their time because they can't do the same research or analysis that Mark Yusko at Morgan Creek Digital Assets can do. I'm sorry, Digital Capital. What we're ultimately interested in is helping people understand that if that's what you want to do, if you want to make a responsible allocation, if you want to do almost exactly what you're describing, Mark, there really hasn't been a mechanism for people to do that. It's been possible for people to make a 1% allocation and allow that to grow without selling it and make it a giant portion of their portfolio. And that's a huge success story. And people should be applauded for that, right? Nobody's more thrilled for Dan at Pantera than I am. But the underlying character for most people is that unfortunately that ends up driving what I describe as portfolio imbalance syndrome, where they have laser eyes spouting from their avatars and they're screaming about absolute certainty about what the future holds. And I don't know, right? And so, I happen to think that the networks, as Harley does, the networks of the nation states are going to attack back. And it's going to be interesting and uncertain how this plays out. But I think we all agree that there's an element of how do you allocate and what can be done. And for me, the exciting part is actually being able to play a role and facilitate some of that. So I think that we're actually ultimately, while we differ widely on a lot of these components, we come back to the same underlying.
We wouldn't be doing this if we didn't have stuff in common. But most importantly, the whole idea that if two people always have the same opinion, one is unnecessary.
Right.
I like to be necessary. You like to be necessary. Harley likes to be necessary. What we're doing is we're having a dialogue and debate in search of truth. We all come from our own biased places. We all come from, look, I've been very blessed. I've been very lucky in my life to have invested in infrastructure around technological innovation. I grew up in Seattle. Most of my friends don't work. They went to work for this little company called Microsoft. I was too stupid to do that. Now, I defend myself saying, if you ever seen the picture of the original Microsoft 11, you'd forgive me. They were kind of rough looking, but I didn't do it, okay? And then in 96, 14 years later, I did put $500,000 for Notre Dame into this little company called Google, and we took out 200 million. Awesome. There should be a quad at Notre Dame called the Google Quad. And then 14 years later, in 2010 at Morgan Creek, we put a bunch of money into infrastructure around the mobile net. And we made a gazillion, technical term, dollars in Facebook and Alibaba and a whole bunch of businesses, again, for our clients, not for me. And now 2024, which is still 3 years from now, y'all, 2024 is the trust net. It is the evolution of this technology. It happens every 14 years, and there is no putting the genie back in the bottle. And whether you believe in Bitcoin, Ethereum, DeFi, it doesn't matter. Everything is moving to blockchain as the operating system for the internet of everything. And imagine this world. We'll be sitting in the back of our autonomous vehicle. It will pull into the charging station. You won't get out and put a stupid card in a machine. Are you kidding me? The car will pay the machine in cryptocurrency. It will happen instantaneously. You'll pull away, you'll get into traffic, and you'll decide, I don't want to sit in traffic. You won't go into the lane and have a license plate picture taken and send you in through the mail. You have that check on your desk for 26 cents. You won't send a check to the tax department for the toll. The car will pay the freaking toll in cryptocurrency. And then I will, because I'll be a Waze Plus customer, I will get to go on the fast route, what tells all the rest of y'all to go on the slow route, okay? And I'll pay in cryptocurrency. So all of this is going to happen. There's no chance that it's not. And so the idea that nation states are going to disappear, I'm not there. I'm not an anarchist. Do I think that we now have a borderless currency for the first time in history? Yes, we do.
I'm going to cut you off there because we are going to run out of time. But you used a couple of really critical phrases there that I just want to hit off of. The first is, I agree with you that a lot of what you're describing is inevitable. The question ultimately is, what is the base layer technology that plays through here, right? I think Bitcoin is far along than you do, but that's ultimately what makes markets, right?
Of course.
And ironically, we both agree on the dynamics of allocation and the challenges associated with that. I do want to wrap it up by ultimately saying how blessed I am for having had the chance to get to know you over the past 30 years and have the opportunity to do the same with Harley and to bring all of us together here to discuss in occasionally heated terms the future of this asset class. Thank you so much. This was really fantastic. We've got an unbelievable number of comments. We're just going to run out of the ability to answer questions this time. But this was an absolute blast, Mark, and I'd love to do this again at some point in the future.
No, I do it anytime. I feel equally blessed for the relationship we've had for all these decades. And we have had many, many, many great discussions. This is just one of them. Look, I am a hyperbolic personality. I do get too heated. I love debate. Obviously, Harley, I would love to do this more and talk. Look, all the points that Harley brings out, all the points you bring out, all the points I bring, it's all about bringing those points out and having dialogue. What I hate is we become so tribal. We become so, oh, if that person says this and disagrees with me, they're dead to me. I'm blocking them. No, you should seek opinions that are different from your own. You should seek people who you respect and admire and have, dialogue and debate. This is a blast. I love doing this, and I hope people
I could
benefit.
have one more comment here, just a word from our sponsor, that notwithstanding my opinion, there's plenty of times when I'm wrong, and having a vehicle where you can go and make that allocation is highly rational. So,
oh no, Harley, look, my wife's only seen me speak one time. She came to Vegas, watched me speak. At the end, she says, "Mark, you can't say things like that." I'm like what? She says, "You say things so forcefully." I'm like, "Well, what's wrong with that?" She says, "Well, people will believe you." I'm like, well, that's kind of the idea. She says, "Well, what if you're wrong?" I said, "I'm wrong all the time. I just changed my mind." But your point is exactly right. The product that you guys have created, the reason it's so important is because we're talking about technological evolution, because we're talking about nation states and power. It is very scary to take the leap. It's my pinned tweet, right? The greatest wealth is created by investing in something you believe in before others even understand. You'll be mocked, you'll be ridiculed, but it's worth it. What you're doing is you're providing a cover for people to say, I can do this with professionals who will do the most important thing, which is to discipline rebalance. Because the human reaction is when Bitcoin's at 64K to press the metal to the floor. No, rebalance. And then when it comes down to 30, buy more and rebalance. The difference between rebalancing and speculating, rebalancing moves you back to a strategic target, speculating moves you away. You guys have a product that rebalances using discipline to bring what I believe is the most important technology of this century into the average advisor's portfolio. Bravo.
And thus we agree.
Absolutely. Let's close on that note. We'll let Brian wrap it up.
All right, guys, this was an awesome conversation. That was so much fun. So Mark, thank you so much for joining us today. Thank the audience for tuning in. So we're going to do this monthly. Next time is Thursday, July 8th. Mark, you're welcome to join us. We're going to have Harley and Mike discussing with inflation celebrity, Mike Aston. So, keep tune into our website, take a look there. We'll have the registration available, but hopefully we'll have this conversation that everyone just listened to available for replay, but it may have been a little bit too interesting for compliance. But thank you everyone again for joining us, and have a great evening.